What's going on, everybody? Welcome back to another video. In this video, as you can see from the title, I'm going to be explaining the trading terms and what they are and what they mean. So let's just get straight into this video. Not going to take too long of the intro. The first term we're going over is called bullish. Now, whenever you hear the term bullish, it essentially means the market is going up. So for an example, whenever we hear the term bullish, that means the market is making higher highs and lower lows, and higher highs and lower lows, and higher highs and lower lows, and higher highs. So whenever you see the market like this, it means that the market is in a bullish market. So whenever you hear the term bullish, it means that the market is in an uptrend. Now, what is an uptrend? An uptrend is when the market is making higher highs, lower low, higher high, lower low, and a higher high, and a lower low, and a higher high. So this is called a bullish uptrend. The opposite of a bullish trend is a bearish trend. Now, whenever you hear the term bearish, it means that the market is going down. So whenever you hear the term bearish downtrend, it means that the market is in a downtrend. Now, you see how right here we made lower lows. The market is essentially going to break that low and then make a lower high, and then another lower low, and a lower high, a lower low, a lower high, a lower low, a lower high, so forth. So whenever you see this trend, it's called a bearish downtrend. Whenever you see this trend, it's called a bullish uptrend. So this is self-explanatory. Whenever somebody says that they're in a long position, it means that they are in buys in the market. They're buying the market. So they're buying the market at a lower price to sell the market at a higher price. Now, whenever you hear somebody say that they're in a short, it means that they're selling the market. They're selling the market at a high price to sell the market at a lower price. So it's self-explanatory. Long position, somebody is buying the market. Short position, somebody is selling the market. Now, the next term that we're going over is called a bullish fair value gap. Now, as we know, when you hear bullish, it means that the market is going up. So now when you see a bullish fair value gap, let me use an example. A bullish fair value gap is when you see 3 consecutive candlesticks that forms a gap in the market. So right, we see this one candlestick got formed, second candlestick got formed, and then the third candlestick got formed. So out of this 3 candlesticks, there left a gap in the market, which is called a fair value gap. Now, when the market is in a bullish uptrend and you see a gap being formed, that's called a bullish fair value gap. Price tends to use this gaps as a draw in liquidity to move up higher. Let me show another example of a bullish fair value gap. Another example of a bullish fair value gap is this one right here. You can see the first candlestick, the second candlestick, and then the third candlestick that we formed the gap. So the fair value gap begins at the high of this wick right here on the first gap till the low on the third gap forms a fair value gap that price often comes and retraces into as a draw on liquidity to move price higher. Now that's a bullish fair value gap. Now that we went over a bullish fair value gap, now the bearish fair value gap is the opposite. The bearish gap is the same situation, 3 consecutive candlesticks that forms a gap in the market. Now let me show you an example of a bearish fair value gap. So the first example is right here. The first candlestick, the second candlestick, and then the third candlestick forms a gap in the market. You start at the low of the first candlestick for a bearish fair value gap, and then to the high at the third candlestick. Now this forms a gap that price often retraces into for price to move down. So now the difference between a bullish and a bearish. Well, now we know that bullish means that price is in an uptrend. Now bearish means that price is in a downtrend. Now price formed a bearish fair value gap that price often retraces into as a draw on liquidity. Now in this case, this is a bearish fair value gap. Price is retracing into it to move farther towards the downside. Now let me show you one more example of a bearish fair value gap. So this example right here. So now as we can see, the first candlestick, the second candlestick, and then the third candlestick formed a gap in the market. As we can see, price came and retraced into this bearish fair value gap to displace farther towards the downside. So that's the end of this video. I don't want to make this video too complicated for you. That was a lot that I just dropped on you, and especially as a beginner, I don't want to make it too complicated for you. So go over and review all these terms that I just dropped to you. I'm going to be coming out with more videos. Stay tuned. If you enjoy the content, if you found value in this video, make sure you like, comment, and subscribe. I'm gonna catch y'all boys in the next video.